We're going to try this again. This is part 2 of the current report from MBS Highway. And Joan's right around here somewhere, and she's not going to join me. Again, the morning market report from the mortgage-backed securities. MBS Highway is the name of the website. We'll play their morning report. And I don't really want to hear the R word.
Hey,
but
we were the first to tell you that there's a
don't really want to hear the R word, but looks like it's going to be a reality for us.
recession potentially on the horizon. What does that mean to you? Because we feel it coming.
Yeah. Please tell me that I can't, that I won't, that I fail, that I'll never make it out, yeah. Please tell me all the bad, never good, fill my head full of every single doubt, yeah. Please say any negative thoughts, I pop off when I hear people say I cannot. I get off to the thought of proving everyone wrong, I won't stop to the top, so you better back off and get lost. I'ma stay loud, stay proud, never running out, never heading south. I'll be spreading out, call it word of mouth, can't put me down.
Good morning, everyone. Mortgage-backed securities are down 9 basis points right now. Not terrible, but they're flirting with that downward trend. We'll talk about it and show you in just a minute. You know, there's so much naysaying going out there almost every day about housing. We read about it. And I'm very proud to say that we have called this beautifully on housing and felt like we've been on an island for most of the time, especially with all the negativity in the media. And hopefully you've been able to relay that to customers who have greatly benefited because of that. But it hasn't just been on housing. You know, talking about what is going on with inflation, for example. Many times people have called, and they're calling for it now, peak inflation. Last year, several times we told you inflation was going to rise. We explained that that's going to cause mortgage rates to rise. We gave the earliest of all warnings on that. In fact, as you can see here, back in September, we said don't be fooled because people were calling for peak inflation. That was when inflation was at 4% because they don't understand the metrics. And when I hear people talk about peak inflation right now, they're wrong because the way we see it, and we've explained it to you, we've shown you the charts, we don't see peak inflation until we get to about September, October period. As we get closer, we'll narrow it down. But that's when we see peak inflation. So it could be a bumpy ride until then. But what's beyond that is a recession. And look, we were amongst the first to call for a recession. We were on an island. Heck, I remember back in 2019 when we were telling you recession's coming, people would poke fun at us. Our friend Rob Crispin, he's our friend.
By the way, to Pete Economist's credit, he actually prognosticated this a few weeks back or even a month or two prior. So kudos to Pete. You have the crystal ball.
He would poke fun at us, as many did, thinking there was inconceivable.
Oh, it's buffering again. This is not good. Let's try this again. Let me check my internet service here. I'm gonna stop sharing really quick. Maybe
to see a recession. Sure enough, we got that in January 2020. Why do I bring up all this? Because we now, not only are we seeing and hearing from so many others who agree with us, finally people coming on board saying they see a recession, but what does this mean to you? When we get a recession, interest rates decline, housing does well. We've shown you the charts. Now, if we do indeed get peak inflation around the September-October period, it almost sets up to be a perfect situation. You get supply chain loosening. As supply chain loosens, that helps to bring inflation down. As the Fed hikes start to take hold, gives people an incentive to save. It takes money out of the economy, less inflation. It means that there's demand destruction.
This is a great conversation, by the way.
Less spending, it means that inflation will decline. Now, all those things.
Let's try to stop sharing again.
Mean lower interest rates. Housing, If supply chain loosens up, we'll get more inventory. So slower appreciation, but more transactions. From a mortgage perspective, mortgage originator perspective, you got to be looking at more real estate transactions, more refinances. All the loans that are being done today are simply the seeds that are being planted for tomorrow's refinances.
So he just mentioned the outcome of what we will experience when we do have a recession. There will be more transactions, a more balanced market. So that's what he's saying.
When you look at your rate sheet and you want to be a little discouraged potentially, or you feel a little discouraged, don't be. This is a window. There's a period in time that is literally setting you up for a very, very good future ahead. And I want you to look ahead. It's not that far in the distance. Let's get 6 months down the road. Let's work hard, get through this period, because the rewards will start to be great as we continue.
And Barry, we also got the Q1 GDP reading this morning, and this was down 1.4%. The estimate was for it to be up 1%, and this is coming off of a strong Q4 GDP from 2021 of up 6.9%. So what happened here? Well, we told you that these numbers were going to be coming down. Q4, we said most of that was inventory build. And now that we're seeing a negative reading, this has even more people out there saying, hey, maybe there's going to be a recession, because the NBER, the National Bureau of Economic Research, they're the ones that are like the referee calling this thing. And one of the things that's kind of your traditional benchmark of a recession is 2 consecutive quarters of negative GDP. Now, this is the first reading that's negative for Q1. They're going to have 2 more revisions to this, but so long as it stays negative, well, that's 1 negative quarter of GDP. And this has a lot of people out there talking about a recession and asking if the Fed is going to potentially now reverse course. I don't believe so. The Fed has come out many times and said, listen, inflation is the biggest problem out there, and they're going to continue to hike to try to curb this inflation, as you just mentioned, Barry. But I want to show you a chart, because some people are trying to debate, is the Fed going to be able to achieve a soft landing, or are we going to get a recession? Well, check this out. When you take a look at this, this is a chart showing you recessions in these gray vertical lines, and then this blue line here is the Fed funds rate. And you could see how the Fed, when they want to slow down the economy, when they want to fight inflation, how they hike this Fed funds rate up, up, up. And look at, once it reaches its peak here, you then see a recession to follow, and then you see the Fed reverse course. Take a look back here in the 70s. We've talked to you guys many times about past Fed presidents like Paul Volcker, and look how he hiked the Fed funds rate from around 5% all the way up to 17.5%. And then we got the recession, and then look how quickly they reversed course. And then the economy started picking up again. Inflation started rearing its head, and they once again took that thing way up to almost 20% before having to reverse course again. Now, the Fed nowadays is a little bit more stable with their direction, but you could really see the Fed being like mad scientists back here, adjusting the Fed funds rate up and down to try to manipulate the economy. Take a look back here in the 90s. You saw after having, and by the way, after having 2 recessions here back to back, you could see here in the early 80s the Fed started to hike here again, but then they got scared because they saw the previous 2 times what happened, and they reversed course, and we were able to avoid the recession. In the 90s here, well, we had the internet come out, and the supply was more available out there. People were able to get more products thanks to the internet. You also see expanding growth. So we saw a little bit of a stabilization here in the Fed funds rate. But then once we saw in the beginning of the 2000s here, they started to hike the Fed funds rate again. We got a recession, and they had to reverse course. Now, where are we here now? They're starting to hike the Fed funds rate. If you believe the Fed and many of the members speaking, they want to take this thing up maybe to 2.5% to 3% potentially. Some even saying 3.5%. Well, what's going to happen? I mean, look at this pattern. Every time they hike the Fed funds rate, we usually get a recession to follow, because they destroy that demand, as you said, Barry. They slow down the economy. They're behind the 8 ball, and in my opinion, and I know yours as well, they're one of the reasons why we see these boom and bust cycles.
Yeah, we feel that the case for recession is very strong. We're amongst the first to kind of read the tea leaves, see that inflation, know what the Fed had to do, and once the Fed is doing it, we know that that is almost always the case for recessions.
Barry, you mentioned a lot of negativity from the media as far as housing goes. But we see a lot of positivity, and we did get a report in today from the Census Bureau. This is their quarterly vacancy report showing us that vacancies are on the decline. As far as rental vacancies go, they're down 1% year over year, coming in at 5.8%. And as far as homeownership vacancies, those are down 0.1% year over year, coming in at 0.8%. And the reason that this is so important is, again, talking about the media. They've been saying that there's going to be a housing bubble. But when we see a housing bubble, that is to high vacancies, not a low vacancy rate. Low vacancies actually point to greater demand, and it really supports appreciation growth.
And today we got initial jobless claims like we do every Thursday, and this came in at 180,000, in line with expectations, down 5,000 for the week. Individuals continuing to receive benefits is relatively unchanged at 1.4 million. So while claims are at really low levels and the unemployment rate is at 3.6%, remember, we're talking about recessions. Recessions happen at the low of the unemployment rate, and we think a recession is coming. So claims may start to tick higher as that unemployment rate starts to move higher as well.
Yeah, Jake, and just to underscore your point, I think it's interesting to take a look at a chart like this where we do show how reliable an indicator unemployment rate is to recessions. So when you look at this, you'll see all the way back since the 50s and 40s, you're going to see that when we hit that lowest level and the unemployment rate start to tick higher, that's when we reach recession. Lowest point, tick higher, recession. And every single time, and if you look at where we are now, I think we could all say we're at the lower end versus the higher end. So maybe we'll start to see that tick higher. And once we do, it'll be a really telltale sign.
Yeah. And Diana, just to underscore that point as you leave that chart up, conceptually speaking, you might think that recessions are when the unemployment rate's at its highest point. But as you guys stated correctly, when it's at its lowest point and then begins to turn higher. Because what happens is you have a tight labor market, the economy's doing good, but once things start to slow down, businesses start feeling that, and the first thing they do is they start to lay off workers. But then those people that were maybe going out and shopping, going to retail stores, going out to dinner, going to the movies, they change their buying habits, and this has a snowball effect. And then those companies that were reliant on their business, they start to lay people off, and you see this thing spiral up very, very quickly. And this happens during recessionary periods. So happens when you see the low and then turn higher. And as you said, Jake, we have not started to see that turn higher yet. We're near the low we saw pre-COVID at 3.5%, right now at 3.6%, but we'll probably start to see some clues with the initial jobless claims. If we start to see that tick higher and then start to see the unemployment rate move higher, that'll be another confluence or indicator for us that a recession could be on the horizon.
Yeah, and speaking of the unemployment rate, I can't believe I'm saying this already, but it's already jobs week next week. So on Friday, we'll get the BLS jobs report, and we're expecting that the unemployment rate stays at 3.6%. That's what the expectations are. And remember that tomorrow we get the PCE report, a very important inflation measure.
Thanks, Di. When we take a look at the charts, just a real quick here, we are down 14, 10-year treasuries back up to 285. Very short-lived couple of days here of seeing improvement, and that's why we've been grabbing these and trying to lock off and let it ride up and grab these little things. It's like grabbing the gains when we can. We've been doing that over and over and over again to try and help manage this through these difficult times. Navigating it is difficult, and you can see there's been quite a bit of volatility in moves within the market. So we're down 9 right now. We're kind of flirting with this downward trend. At least we're on the top side of it. I know it doesn't feel much better, but it is important to stay topside here because even though the trend is still negative and lower.
We're going to end the video right here. Again, recession is not something to be feared about in relation to how the market, the real estate market that is performs. We're looking towards a balanced market. We'll continue to update everyone on how we get these reports from MBS Highway. If you have any questions, feel free to DM us on our social media channels, Instagram, Facebook, our company Facebook page. Private message me here on Facebook, and I would be happy to answer all of your questions. Again, have a great day. Hope you're having a great start to your Thursday. Today's Thursday. Thank you.